So morning everybody, this is another one of our webinars. It's on pre-pack administrations and evaluators reports in practice. For those of you who don't know me, can get my slides to move. So I joined Manolete last year, 26 years experience in contentious and non-contentious insolvency, speak regularly at conferences and deliver training. And I have to get it in, I'm very excited today because I'm a gunner and I'm still celebrating the win of the Premiership. I might get that in a few more times today, but I'm a little bit giddy today, so I'm going to apologise in advance for that. Not really. And then I'm joined today by Johnny. Johnny, thank you ever so much for agreeing to do this. If you'd just like to introduce yourself to everybody, that would be fab. You're on mute, Johnny.
Good morning, everybody. Thank you very much for having me on today. My name is Johnny Abraham from J9's Advisory. For anyone that doesn't know me, I'm an ICAW fellow chartered accountant, specialising in business funding and rescue. And I've been in the industry for 25 years this year, and I've operated under J9 Advisory for 12 years this year. So I'm an FCA chartered accountant. I've an IFT member. I'm also president of the TMA UK for the next 2 years. I started my career at PricewaterhouseCoopers, moved into asset-based lending at Barclays, spent some time at Begbie's Traynor, and I set up on my own in 2014. And yes, since the pre-pack evaluator regulations came in 2021, I'm probably amongst some of the kind of top evaluators in the country, I'd say, in terms of complex transactions. Yeah, so that's me.
Okay, great. So what we've done is we put out to everybody whether anyone had any questions that they wanted us to address today. So we're just going to talk around a few of the subjects and hopefully answer the questions that have already been asked. If anybody wants to ask any further questions, you can either put them in the chat box, or if you want to remain anonymous, as some people do, you can either drop me an email or send me a WhatsApp, and I'll put my details in the chat box in a minute. This session is being recorded, and a copy of the recording will be sent out to you either tomorrow or kind of early next week, remembering obviously that it is a bank holiday on Monday. So, Johnny, one of the first things to talk about is who's a connected party for the purposes of the regulations, because obviously that's what one of the things that kicks them in. When I was in private practice and doing kind of pre-packs, one thing that I came across, and this was kind of earlier on, you know, in the life of the regulations, was what the definition of a connected person was, because obviously the definition of a connected party for the purposes of the regulations is wider than we would kind of historically know if we're looking at, you know, transactions and undervalue preferences, any of that kind of thing. And one thing that I did come across was I was acting on a pre-pack where I was acting for the father of a director of an insolvent company and it was the father that was buying the business and assets of the Oldco through a pre-pack. And we got into this situation where the IP's view was that the purchaser wasn't a connected party and therefore an evaluator's report wasn't required. And my view was that a report was required. And you kind of get into that weird situation, don't you, where it's the purchaser's responsibility to get the evaluator's report, but the IP's got to be satisfied that the evaluator is kind of a proper person. So obviously you've got to have cooperation from both. And we ended up having quite a back and forth on it. And I ended up taking the position that I was advising my client not to complete the transaction unless the IP agreed, you know, that we got an evaluator's report, because I was very firmly of the view that my client did fall within the kind of definition.
Yeah.
The IP, to be fair to them, then changed their mind and did engage with the process. So I guess the questions that arise out of that for you are, obviously we're a lot further down the line in terms of evaluators report. So has that understanding of who a connected party is kind of improved? Who's the main connected party that you tend to come across in pre-pack situations? And are you seeing many situations where the purchaser isn't a connected party, but they do still want that evaluator's report, and kind of what the main reasons are for that? There you go, bombarded you with a load of questions.
There we go, 3 questions in one. So, yeah, I suppose who is the connected party was a bit of a grey area at one point in terms of who was going to get captured under that. I think now, kind of rule of thumb, I mean, the example he gave just then, it's quite clear that father would be a direct relative and therefore would very much be a connected party. But I think if you just go down who constitutes a connected party, we'd be talking, obviously, current directors and even previous directors and officers of the company, relatives of those directors, and also shareholders, that would be as well, by the way, business partners, any shareholder, to me, definitely that counts as a person with significant control would count as a connected person. Maybe a grey area if they have less than 25%. Associated companies that are acquiring would also be classed as connected. Trustees would be classed as connected. And also one that comes up, and again, people kind of solves a bit of a grey area, was certain secured creditors where they're holding security over shares would also class as a connected person. Even though they don't directly hold the shares, if they hold security and they can enforce on those shares and then technically appoint/control, they would also be classed as connected.
Right.
So yeah, there's quite a broad range of people in there. I suppose the rule of thumb for me is if you're unsure, then you would be better off getting a report than not, to be safe. And ultimately, you just you're producing more transparency for creditors and stakeholders at the end of the day doing that. Who's the main connected party that we come across in pre-packs? It's generally owner-managed businesses where you've got, directors, shareholders. That is what we mainly come across. Though when you start to get into more of the complex transactions, that net opens up quite significantly. And also, previous director and shareholders is also one that we see quite regularly as well. Do we have many evaluator reports where the purchaser is not connected? Yeah, so we're increasingly starting to see that now. So previously, it was probably more of the American, more risk-averse firms where they would rather, if there's any vague grey area, they would rather have the report done for the file to say they've ticked all the boxes and done all they can. We're probably seeing an increase in requests now where potentially not actually connected, but the IP would rather have an independent view on the file as well. So we're increasingly seeing that.
Yeah, so is that's coming more from the IPs, is it, than the potential purchasers?
Yeah, IP driven, not purchaser driven.
Yeah, and are the purchasers quite happy to incur that extra cost in those circumstances?
I'm not sure anyone's so excited about incurring extra costs, but it's it's a risk mitigation point, isn't it? And my point to the purchasers, look, if you have an external independent view on this, it only provides more comfort to all the stakeholders that this has been reviewed and in the long run is probably worth the money completing that.
Okay. So moving on to the next, sorry, I've still got this pinging in my ear of people joining. So what constitutes a substantial disposal? I mean, obviously that's, there's a statutory definition of that: disposal, hiring out of sale to one or more connected parties during the period of 8 weeks, beginning with the date of administration. I think people kind of balked to start with at the 8-week period, because that's, pre-pack was always kind of viewed, wasn't it, as anything kind of in the first few days of yes. An appointment. But I remember kind of deals where you'd have a situation where the structure of a deal would be kind of sufficient in order for TUPE to kick in, and for kind of employees to be transferred over, but it wouldn't necessarily be enough of the business being transferred for the purchaser to be able to rely on the exceptions in kind of section 216 of the Insolvency Act for reuse of prohibited names. I also had a job which still haunts me to this day, and gives me PTSD when I walk into a kebab shop. So we did a pre-pack of a cold food business, and we sold the business and the assets were defined as the assets of the company at the trading premises. Like, there was a particular address given. After completion, a few days later, it transpired that the director, who was also the purchaser, hadn't disclosed that the company had a big cold food storage lockup on a different site, probably if I'm being cynical, trying to pull a fast one. When this was discovered and we got access to it, it was packed floor to ceiling with frozen big, like doner kebab legs, you know, the ones that kind of like go on the spindle things. And that created a big kind of dispute or discussion as to kind of how much of the business had transferred over, because this was quite a valuable asset. You know, it was worth quite a bit of money, which hadn't been sold under the SPA because of the definition of assets within the agreement. So what that's always highlighted to me is that it's not always straightforward as to whether or not you've got a substantial disposal or not. So I guess the questions that come out of that are, do you see much thought going into what constitutes a substantial disposal, or do people kind of just assume, they take the view that yes it is, so that they fall within the regulations and therefore get the report? Do you ever have situations where your view differs from the IP or the purchaser as to whether or not something is a substantial disposal? And then I guess the final one, is it always safer to assume yes it is a substantial disposal and get that report, because then you've got that belt and braces just in case? So again, lots more questions in one there for you.
You know, there's no real guidance as to what a substantial disposal is or the kind of metrics behind that. So obviously it's just a few desks and chairs are getting sold off, and you're not going to have to do a report for that. But I think it comes down to feel. So where you've asked, does my view ever differ from the IP or the purchaser? Some IPs won't put the call in anyway, so we'll never get to hear about it. We do have some IPs that will call up, or lawyers that will call up and say, this is a case we've got on, what do you think? Do you think we need a report? Do you think we don't? And often it's very much, well, how does it feel? If it feels like it's substantial to that business, then you probably should be doing it. And then going back to what you said then, is it safer to assume that, is it safer to assume that it is a substantial disposal? Well, if you sat on the fence thinking, is it not? Again, it's safer to get that report done, so you've got that independent view, and you've, like you said, you've done the belts and braces approach. But yeah, very rarely, if an IP is putting a call in to say, do you think we need one on this? They've probably answered the question themselves by calling me in the first place. You'll have other IPs where they don't want the report doing, so they just won't call anyway. So we can't really differ with those guys.
Okay. Sorry, as I'm coughing and spluttering. So another kind of a talking point really is around the timing of evaluators reports. So when I was in practice, I'd get some situations where the evaluators report would be got really late on, but I did have situations where the evaluators report would be got really early on, and I actually had one where the evaluators report was obtained before I was even instructed to draft the SPA. And obviously an evaluator's report is only worth the paper it's written on if it relates to the transaction that's actually being entered into. And I guess, it kind of comes back to my view of, I suppose, revenue. If you get tax clearance, if a tiny thing changes, then revenue will say you haven't got tax clearance for that particular transaction. Yeah. And obviously deal structures can change right up to the last minute, yeah. And particularly when the SPA is being negotiated, and it may be that the terms of a guarantee or security might change, but the structure of the consideration might be altered. Some assets might end up being included, some assets might end up being excluded. So what's your kind of view on at what point in the transaction should the evaluator's report be commissioned? And where are the risks in terms of at what point would you view the transaction differing from kind of the transaction that was originally put forward? Because some people will want the clock to start ticking on getting that evaluator's report back quite quickly, because it's a time, as all pre-packs, it's kind of like a time sensitive deal, but there's the balance there, isn't there, to be struck? So just interested in how you approach that, what you see.
Different evaluators work in different ways. So I can only speak for myself, really. So for me, it's more, the sooner I can get a call to let me know that something's coming in, the better, so I know what the workflow is going to look like. But I personally don't release evaluator reports until we've actually seen the final draft of the SPA. And that's to make sure that we've reviewed and we're producing a report that reflects the transaction that's actually been completed. So my report will match the SPA and then match the administrator's proposals. I've seen and heard of in the past evaluator reports that, like he said, have been done at a completely inappropriate time, and therefore their report doesn't actually reflect what's being completed on an SPA. So technically, that evaluator report is completely worthless. So there's no point in the IP kind of putting that in their proposals to say we've got an evaluator report, because the two don't match up. And like you said, there is a lot that changes over time when you get to the actual SPA point and all the negotiations really start. So whilst we can have a call and say, look, this is the gist of a transaction that's coming in, it's not until quite later down the line that we actually release the final report, once we've actually seen the final draft.
Yeah.
And especially with more complex transactions, I might get a month or two notice of a transaction that's going to potentially come in, but there might be $1 billion transactions in effect that are taking place. So there's a lot more going on in them. So we need to be made aware that that transaction's coming in, because it takes far more time to review.
Yeah. Okay, but I mean,
so yeah, I suppose letting evaluators know as quickly as possible, because whilst we can turn things around overnight, it's better to have as much time as possible to know that these things are coming in. So yeah, let the evaluators know, but in terms of actually commissioning and actually wanting that report on your desk, I think lawyers lawyers need to know that that report is being completed and that it's not just sat on somebody's to-do list. But getting that report too early can be to the detriment if it doesn't reflect the actual transaction that's been completed.
And do you get situations where the lawyers review the evaluators' reports?
Yeah, generally both sides, both the purchasers, lawyers, and I'll always release a report and ask that the IP and anyone involved checks the report to make sure there's no misunderstandings, no errors, to make sure we've not got anything wrong in there. So, and it generally comes down to misunderstandings of facts that are being given, or if there's been any tweaks post the final version of SPA that were being given. So, but yeah, the lawyers generally do review on the cases that we look at, especially when they're larger, more complex transactions.
Yeah. Okay. Great. And then next topic is kind of information requirements and the evidential expectations placed on evaluations, on evaluators even. So obviously there's information that you need in order to be able to prepare your report.
Yeah.
And in theory, this should come from the connected party, but presumably most of it actually does come from the from the IP or the IP's office. So how do you approach what information you obtain, and how do you assess it, evaluate it? Is there anything that you find that tends to be kind of not seen necessarily as relevant, which evaluators would perceive as relevant? So it's information that you'll always tend to be asking for. And do people still do viability reports? Are they still relevant? Are they worth anything?
Okay, so in terms of obtaining the information, so again, I'll just speak for myself. I have two different information packs that go out. One goes to the proposed purchaser and one goes to the proposed insolvency practitioner. So we have two different packs. The pack that goes to the proposed purchaser is predominantly background information on the old co, details of their offer, financial forecasts for new co, business plans for new co, that kind of thing. Details of the connected parties, which we've got to then check because they'll often miss people off, or we've got to go through the company's house searches and say, who's this, are they going to be connected, are these people going to have roles, to make sure that we've covered everybody off. The pack that goes to the IP is looking for details like confirmation of 2P employees that are transferring across. The most significant one, I think, is the copies of the valuations. So again, I'll speak for myself. We have two different packs because we'll ensure that the buyer does not see the valuations that have been done. I've seen examples of reports where evaluators are literally stating what all the valuation figures are in their evaluator report. We never disclose to the purchaser what the valuation figures are, because if I was a buyer and I engaged a report and it literally tells me all the values, there would probably be a price sheet, and the report basically says I'm the only person putting a bid in, and by the way, here's all the valuation figures. I'd probably be reducing my bid after that. So I don't release the valuation figures to the purchasers. So we have two separate packs. The purchasers, when they engage, know that we'll be receiving information that they will not be party to, but it means that we can review that. Evaluation and know what's going on, basically. And my document basically states we've had sight of evaluation from X and Y, and that we've reviewed that as well. So that's probably the biggest difference between the two packs.
Yeah.
One is more background information, but then the real information comes from the IP in terms of valuations, final draft, drafts, SPAs, that kind of stuff, confirmation of employment numbers, TP numbers, that kind of thing. How do I assess and evaluate it? Generally read it, put some thought into it. And again, personally, I'll go on the basis of if this file was to be reviewed, or if I was disgruntled, what would I want to see and know? And those are the kind of questions I'll generally go back with to purchaser or IP to say, can you give me more information on the following, to make sure that we have that all on file? And if we don't get an answer that I think the creditor, HMRC is a big creditor in most cases. If HMRC picks this up, would they be happy with this explanation as to what's happened or what's going on? So we'll really push to get the answers on certain questions. Viability reports. Viability statement, they can put whatever they want in there technically, can't they? So I'm not as bothered about that. I think for me, it's more estimated outcome statements from the IPs, where we've got different options going on. Also, I'm more generally concerned where there is deferred consideration. So we need to know that Newco is going to survive and it's got enough funding behind it. So I'm probably more concerned about looking at cash flow forecasts and the business plan rather than viability statements. And we've had scenarios before where we've been sent a cash flow forecast and there's a massive hole in it in 2 months' time, and you kind of go back to them and say, you've got a big hole in your cash flow forecast, how are you going to fund that? And go, oh, I don't know, we'll think about that later. Can't do that. You need to have a plan now. We can't sign this off on the basis of there's deferred consideration on here and you don't know if this is going to work or not.
Yeah, it's interesting, isn't it?
Funding later.
Yeah, I remember having a conversation with a director buying a business back and saying to him, well, what's going to be different this time compared to last time? He said, well, we made a profit in the last few months. I said, well, you made a profit in the last few months because you haven't paid your rent, you haven't paid revenue, you haven't paid, so do purchasers tend to get much, if you're asking them for cash flow forecasts and things like that, is that something that they tend to have thought about before, or are those kind of requests a bit of a surprise to them?
Some have, a lot of them haven't, and it's almost taken as an insult when we ask for it. So it varies. Your bigger, more sophisticated businesses generally tend to have them because they've got proper finance teams in the background and they've prepared all this work. Or quite often they've been asked by the IP. The IP's already asked them for all this. So it tends to be on the smaller end whereby they've not got that. And then they're scrambling around to put one together. But then, things start to come out of the woodwork. And actually, the point is, do you even want to do this transaction? Because actually, it's probably not going to work out. I remember having that conversation, a few times with potential purchasers. Anyone who's heard me talk before on one of my training courses or anything knows I kind of used to get on my soapbox. I get on my soapbox about a lot of things, right? But this was one of the things that I did used to get on my soapbox about, is kind of how people should choose evaluators. Because obviously the connected party chooses, is responsible for the report. They have to instruct an evaluator. But an evaluator's got to meet certain requirements. There's the obvious ones: insurance, not to be connected to the company, or not be interested in the transaction, all those kind of things. But the one that I was always interested in is that the IP has to be satisfied that the evaluator has sufficient knowledge and experience to make the report, and must have no reason to believe that the requirements for being an evaluator aren't met. I mean, personally, I've always thought it's crazy that an evaluator doesn't have to have insolvency experience. I find that quite mad. Actually, the evaluators that I know have all got, they've all worked in the industry, then normally IPs. But there's been a move more recently in terms of kind of valuing assets to think about agent suitability for valuing certain assets. So, for example, you might get a specific agent to value intellectual property, for example, and then have another agent valuing kind of your plant and machinery and that kind of thing, which highlights that there isn't a one size fits all, particularly in our industry.
And obviously when it was just the pre-pack pool, and that was the only option that people had, I think I'm right in saying that even with the pre-pack pool, you don't actually know who the evaluator is going to be. It's kind of done on a, it's done on like a rota basis. So how much thought do you think should go into the identity of the evaluator, and what kind of factors do you think should be taken into account when IPs are considering that?
Yeah, I mean, you mentioned the pre-pack pool there. I suppose the problem with the pre-pack pool is you don't know who's evaluated it until you get the report back. So the buyer nor the IP knows who's actually going to complete the report until it comes back. So all you can do then is go down the profiles of the people that are on there, and people can make their own judgments as to whether those people are actually qualified to produce these reports or not. In terms of background experience, generic qualification. My stance is having a generic qualification as a chartered director doesn't then qualify you to do evaluators reports, because you've not got any experience in our industry. I mean, going back to what you said then, I think it's important that you need evaluators that have actually been on the ground, worked in the industry, completed and worked on a transaction themselves, so they know the legal background that goes into this, the commercial reality of doing one of these deals on the ground. So I think that's very important. In terms of identity, I would say that given that an IP is in effect on the hook for this if it goes wrong, because they've got to be satisfied that the evaluator meets the criteria and they're a suitable person, I would say that they need to know who the individual is, what their background is. And like you said, his background of, professional background, professional qualifications. I actually did an article for R3 where I kind of pushed the basis that actually evaluators should be members of a recognised professional body and active members of that, because then they're a regulated individual technically by that body, and if there's any issues or complaints, there's a proper process to follow. I think we're starting to see, back when this first kicked off in 2021, I think there was probably about 5, if that, key providers in the UK. We've now rapidly seen an increase in the number of individuals that are doing this. Some are doing it kind of in their spare time next to their day jobs. Some are doing it as retirement roles. Some probably should be doing them at all. And I think it's important for the purchaser and the IP more so to know exactly who's providing the report, what their reputation is, what their background is. And let's face it, your reputable firms all know who to use, and they'll use the guys out there that have got the background to tick all the boxes. So yeah, really, it's what's their professional background, what's their professional qualifications, have they actually been in our industry and got the experience of doing this, and are they a reputable person? And I suppose it comes down to, are they satisfied that if this all goes wrong, that person can stand behind their report and explain exactly why they gave a positive report, and the reasoning behind it?
Yeah, but do you think consideration should be given to kind of, the particular industry that the insolvent company is in? So would a construction business, for example, be very different to dealing with a G business?
Yeah, there's very different issues that come out of different sectors. And if I've been in the industry 25 years, so worked on many different jobs in that time and seen many different things. But if you take that, just going back to what you said before about the valuation point. So I've had it before where we had a business where the IP kind of said, oh, well, it's just desk and chairs, so we've got so-and-so to value it. And then when I said to them, yeah, that might be the physical assets, but actually this business, its actual asset is its website, because the website is a lead generator. And then you're then selling those leads off, and that's how you make your money. So your key asset in this business is this website and the way that it generates leads, not the physical. You can't just call up and say there's a few laptops and desks and chairs. So I actually said to them, look, you're going to have to go and get an IP valuation done on this website. So that's the kind of thing where getting an evaluator involved that knows what they're doing will say to them, you need to get this done. And actually the consideration went from this to that, because as I said to them, it's an IP valuation on this website that you need. The desks and chairs and computers are irrelevant. We've had a couple of cases where probably the wrong valuation agents were used, and we've kind of said, look, we'd rather get you to get somebody else at very least to do a desktop on this and just review it and say that they're happy with it. But yeah, that all comes from experience of reviewing these and gut feel as to whether something's right or not.
Yeah. Okay. I've had a couple of questions come in, but we'll box those off at the end. So in terms of, you've kind of touched on this already a little bit, but do you have many kind of causes to actually, say, no, I'm not going to approve this transaction? And if you have, what then happens? Does the transaction tend to fall away? Because obviously the IP could still continue with the deal if they wanted to. They've just got to explain it, haven't they?
Yeah, so I'm not in the business of rejecting things if you can very easily fix a couple of points and make things work. So if there's an issue that I'm not happy with, I will always go back and say, look, can we just tweak this, or can you add this? And if they come back and say, yes, that's fine, then we'll proceed. But the report states, we've asked for the following, they've agreed to this, so great, let's continue. So, I don't just reject things because we're going to just reject it off what's been submitted. We will go back and say, look, can you amend this or change this? The cases where I've rejected tend to be where you've seen multiple failures in the background. They clearly don't really know what they're doing. They've not got any money to put in this, and actually, HMRC and the creditors are funding their cases. So there's a case I was involved with a while ago, chocolate business in the north, where director loved chocolate, knew exactly what she was doing with chocolate, just knew nothing about business basically. So huge HMRC arrears, credit arrears, borrowed money off all sorts of random, high net worths, had lent them some money. And they thought, business is great, I'm still here. Yeah, I've got these issues with HMRC, but all these people are backing me, so here we go. And then, the financial, she didn't have any financial forecasts. When we asked for forecasts, they all came through incorrectly, they were wrong. And then when I asked the question, I asked a really simple question of, if I've got an invoice that's £120, including VAT, what is the VAT element on that invoice? And they got it wrong. Then they got the calculator out and still got it wrong. And I kind of said to them, look, I'm really sorry, but there's no wonder you've got huge HMRC arrears in here, because you just don't understand VAT. And they got quite irate about it. But I had to say to them, look, HMRC isn't here to fund your hobby, and every time it goes wrong, they take the hit on this. So that's an example of the kind of case where we've rejected it on the basis of the director really didn't know what they were doing. Huge HMRC arrears, the forecasts were pie in the sky, deferred consideration involved, no security, and we that was rejected. And there's probably been up maybe 10 that we've rejected over since this has come out.
Yeah.
So not many, because generally there's issues where we can correct. We can put a call into the lawyers, put a call into the IPs, and say, look, I'm not particularly happy with this. Can we change this? And 99% of the time, it's a yes. So, and like I said, it goes up and it's documented to say that we've asked for those changes. So it's very transparent that we got one thing, we've asked for the following, it's been agreed, and therefore we've given a positive report.
Yeah.
So the basis of the reports are still being met. There's still full transparency there, but it means, if we reject a transaction that could very easily been fixed with a few phone calls, well, that could be the difference as to whether that business survives or not, depending on the cash runway and the timelines. So we'll do what we can to make sure it's not a rejection, but we will make it clear these are the changes that are being implemented from what we got through, basically.
Yeah. Okay, cool. This was a question that was submitted before the webinar. So do you come across situations where the proposed transaction seems good and allocation across assets acceptable, but the deal could actually be done out of a liquidation and or the administration purpose isn't clear?
I think there's probably going to be an increase in people that are doing liquidations rather than administrations to get out with the transparency that's provided by these reports. I've seen maybe a couple where actually it could probably be in liquidation rather than admin. I've personally not seen a huge number that could have been liquidations rather than admins, and not really seen many where the admin purpose isn't clear. But yeah, I think especially on the smaller end, on the more unscrupulous end of our industry, I think we would probably see an increase in liquidations rather than administrations to avoid these regulations, I would have said.
Yeah. Okay. And if and in the ones that you've seen where they could have been a liquidation, is that something that gets highlighted, or is that not really a consideration for the evaluator?
I mean, I can make the point, but by the time they've got it to me, it's kind of too far down the line, and it's not really
Yeah.
happened that often. Maybe once or twice. That's it.
Yeah.
Yeah.
Okay. You touched on this slightly when you were talking before, but kind of, and it seems like a really stupid question, but what should an IP do once the evaluator's report is received? I mean, I guess obviously read it. You've already said that you get people to check to make sure it reflects what's, that it reflects the transaction that's actually being entered into. But what should they do then? Just stick it on a file, or is it used for protection further down the line? What kind of steps should be taken? How should it be used, I guess?
It depends on who the evaluator is. So if the purchase has been left to its own devices to go find an evaluator, and generally they will just go on ChatGPT and try and find the cheapest possible provider of an evaluator report. The IP really needs, the first step is who's done it, and are they actually ticking all the boxes to provide this report? So that's the first point. And then if they're happy with that, it's actually checking the report to make sure they're happy with the content. Does the transaction detail in the report actually match what's going on in the transaction? And yeah, read the report to make sure they're happy with it. Have all the connected parties been boxed off? So I had a case recently where we ended up being asked to do a retrospective report because it transpired that there was a connected party on the purchase, which for some reason got missed at the time of completion.
Right.
So yeah, that's one which we've done, and then that report obviously got checked quite heavily. But
what's the situation there though? Because you've done a transaction and not had the report at the time. So what do? You get a retrospective report and then go to the creditors and say, this is the situation. We've got a retrospective report. Are you happy with it? They've not got the...
Well, as far as I'm aware, we did a retrospective report that basically says this transaction's happened on this day. It's since come to light, blah, 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 blah. Therefore, this report's being done retrospectively, but as if it was done prior. And as far as I'm aware, the report went off to say, the connected parties come to our attention, therefore we've had this report done. Here you go, kind of thing. Yeah,
because I guess technically, even if you get the retrospective report, you didn't have it at the time, did you? So I guess that, so technically you've not complied with the regulations, but obviously these things happen.
As soon as it came to light, I mean, and the changes at Companies House now, whereby you've got the online verification, that will reduce the risk of this happening.
Yeah.
When you've got people playing with names, dates of birth online, they don't always come up. So
but I guess it reinforces a point that you were talking about much earlier, which is the thought that goes into who is a connected party. It is that much wider, and to really kind of do the due diligence.
Yeah, so
to make sure you
can speak for myself. We'll take what they've given us, but then I'll also check online the information that's available to see if we can find any other connected parties. We'll also ask the question, is there anyone else we need to be aware of here? We won't just take off face value what they send us, because it'll generally be incorrect.
Yeah.
Because they're not to understand the regs, so
yeah. Okay. Something else I would merrily get on my soapbox about for hours is kind of the perception of pre-packs. I mean, I've always thought pre-packs are fine. It's kind of like the government have never really liked them unless it's like a really big retail situation where it's actually saved a hit on the Redundancy Payments Office. But I'll get off my soapbox now. Do you think evaluators' reports have helped pursue, kind of improve the perception of pre-packs? And actually, going back to what you were saying a few minutes ago, in terms of sometimes you're kind of going back, not necessarily pushing back, but you're asking for further information. You're asking them to, well, actually, we don't really like this. Can this still be tweaked to take this into account? That sounds like it's improving deals that may otherwise have been done anyway, but it's actually kind of improved the quality of those deals. So I'm assuming you're probably going to say yes. Have they helped improve the perception of pre-packs? Because obviously the insolvency service and the regulatory bodies have now said they don't need to they don't need to see the reports, and the insolvency service has said that pre-packs now are kind of considered to be low risk. So the view does seem to have changed and kind of changed quite significantly.
I think in terms of has it improved perception, people in our industry know who the who the reputable firms are to go get these reports from. You know, if you've got a report that's been done by a well-known industry villain, let's say, then it's not going to improve the perception of pre-packs, is it? But if it's reputable people that are producing those reports, then it can only be a good thing. And you know, there's work that we've done on these pre-pack reports whereby we've had consideration increases, improved security, improved terms, just greater protection for creditors, really. You know, things like anti-embarrassment clauses, that's probably the main sticking point where we get pushback. But my point to IP/the lawyers is, look, it's not a huge thing to include. And actually, if the buyer's got no intention of flipping the business moving forward, then what's the problem? So I think we've probably have helped to improve the perception of pre-packs just because you've got another independent person rubber stamping, basically, or raising issues. In terms of improving perception, I think going back to what I said before, I do think there should be probably tighter controls on who can provide these reports. In terms of, like I said, professional background, experience, that kind of stuff. That is the main area where I think we can improve perception. And in terms of the bodies now saying they're low risk, it only takes one job to get some bad PR and all of a sudden it flicks back round again.
Yeah.
And it's all under the spotlight.
Do you find then where you're kind of on the, and I guess maybe it hasn't had time to filter through yet, or maybe it has, but on jobs where you're, you know, you're pushing back or you're suggesting things such as like the anti-embarrassment clauses that we were just talking about, do you find that when you get kind of, you know, report instructions in on another job with the same, you know, with the same IP or same lawyers, that actually they're now picking up on some of the points that you might have raised in a deal or two before and actually incorporating them in before it even comes to you now?
Yes.
Yeah, so I guess that goes more to in terms of whether it's helped kind of improve the improve.
If they know what you're going to look for, then they might as well include it before it gets to me. So yeah,
no, that's really interesting. Okay, I've had that was kind of the main topics we were going to talk about. I have had a question, which I'm just going to read out verbatim. So reports are required for substantial disposal to a connected person within 8 weeks of administration, and it must be filed with the IP's proposals. What of those proposals have already been filed? How do you understand IPs get over that, and have they had issues with Companies House?
Well, the proposals will have been, if the transaction's been done on appointment, in effect, they will have had the report by the time the proposals get submitted. And if it's completed beyond that point, it just go with the progress report, wouldn't it? But in terms of, I mean, I've seen cases before where actually they've not included the report on the back of the proposals, because it is supposed to be filed. Going back to your question before, what does the IP do with it? The evaluator report has to be filed with the proposals at the back of the document. So I have seen cases before where they've basically said, we've had this report done by so and so, blah blah blah, but then they've not gone on to attach it at the back. I've actually seen cases where they probably shouldn't have done the transaction and they've got somebody to sign it off, and it just so happens the report is missing from the back. So yeah, the reports are supposed to get filed at the back. But the question there is, sorry, can you just repeat that question? Sorry.
The reports required must be filed with the IP's proposal. What of those proposals have already been filed? How do you understand IPs get over that, and have they had issues with Companies House?
I've not had anything. To my knowledge, there's not been any now.
Yeah. Okay. One question I was going to ask was, and I'm not asking you to disclose kind of fee structures, but again, talking about what we were talking about earlier, kind of like a one size fits all. Obviously, if somebody were to do an independent business review, they would quote a price for the independent business review based on, complexity, value of the business, kind of, all of those kinds of how long it's going to take, obviously. Lots of evaluators probably started off by the pre-pack pool is kind of like a flat fee of, £1,750 plus VAT. There might be slight kind of variations on that. But I've always wondered whether actually, if you've got a really complex deal, and it doesn't necessarily have to be complex in terms of, it's worth multi-millions of pounds. You can have deals that have small consideration but have got quite complex issues in them. Should the industry expect there to be a more flexible approach to what evaluators charge, taking into account the deal specific that they're dealing with? Because £1,750 plus VAT might be a really good fee on one deal, but on another deal, actually, that might be not a good fee, taking into account the amount of work that might need to be done.
I think in terms of fees, I personally don't see how you can possibly just have a fixed rate fee for all these jobs, because they vary so much in terms of the amount of information you've got to process and read through. And again, talking just purely for myself, pricing is based on transaction value, deemed risks, PR risks, depends on how much debt's in that business, how many employees, and there's various scales of how you'd set those pricings. I think in our industry, the lawyers and the IPs know what they're getting from different providers, and if they need a proper job doing, and they actually want to know that if an issue occurs on one of their jobs, they've got somebody that's going to stand behind them with a proper report that's been properly compiled, and that person can stand behind that report with them and say, this is why we gave this the outcome on this report. Then they know that's not going to come at £1,700 plus VAT. For example, if you compare the reports at the very low end of the market versus the higher end of the market, there's absolutely no comparison in the reports. They're two completely different things.
In what way?
Well, a report that's £1,700 is probably 2 pages of A4, which most of it's standard text from that provider, and a lot of the time doesn't even make sense. So if you read it from start to finish, it doesn't make sense and it's full of errors. So it's one of those, you get what you pay for. If somebody's got a professional background and they're going to do a proper job, it physically cannot be done at that price point.
But there will be evaluators out there who will still provide, a really good report for that amount of money. They might be doing it as a loss leader, for example, for other, for other reasons. But I suppose what you're saying is that we should be more open to, there being different price points for the reports, which are just more deals, more deal specific. I mean, I think the industry's
what I'm saying is, I think the industry's already open to that. They know that there's two different price points in the evaluator roles, but there's two completely different service offerings.
Yeah.
So on the whole, I think the industry is already open to that. I think on the smaller end, where it's all very much cost driven, and actually you'll have IPs on the smaller end generally where they'll be thinking, well, anything that they're paying the evaluator is less money coming to us. So that's where they're very much more concerned about cost. And actually, we would rather they go somewhere else, because actually they tend to be the jobs that have more issues on them. We have issues getting the information in. We have, they tend to be more of a pain to deal with. So I personally am quite happy for those to go off and use the cheaper providers.
What is the risk of, if picking up on some of the points that we've kind of already made, if the report ends up being different to the transaction that's been entered into, if you've got a retrospective report, like you were saying, or there are just errors in the report because there's been a misunderstanding, like you're saying, and nobody's then checked the report to make sure that it does accurately reflect the position. Practically speaking, what is the risk? Because if the regulatory bodies are saying they're not as concerned about seeing these kind of anymore, is it would just be bad luck that that might be a file that is picked up on an inspection and somebody does a deep dive into into that particular transaction, for example?
It's not just that. So I've had a couple of reports where lawyers have ended up with the reports and the proposals on the desk because they're acting for other investors in that business. And this is more on the more complex transactions whereby you've got more sophisticated lenders and investors. and they're wanting to know, has this all been done properly? So everything has to be watertight. So they are getting looked at, be it not by the regulatory bodies, but also by stakeholders.
Yeah.
So, you know,
But
another example is,
where does that risk sit though? Because you can't take action against the evaluator, can you? So they're relatively,
well, technically for us, it's a time risk that we get drawn into having to answer questions later down the line. But
yeah,
also, we've also got to stand by that report and explain what we've done.
yeah,
But, you know, an example of something which came, you know, I did one for a cosmetics business once, whereby the transaction was the buyer was buying the business and assets, and as part of the transaction, they were also going to make sure that everybody was part way through their cosmetic procedures, had everything, you know, everything completed as they went along. So they were going to undertake all the cost involved in finishing those people off. Once the deal was completed, they then decided they weren't going to do that. So I then had one of the creditors, in effect, calling up saying, "Well, your report says this. That's not what they're doing. What are you going to do about it?" And then we got dragged in. I got dragged into that in terms of trying to get the IP to go back to the buyer and get them to do what they've actually contracted to do. So that's the kind of thing where we can end up getting dragged into things. And,
yeah,
you know, in the world of Google now, it only takes one person or two people that are disgruntled on a job to say, "Oh, well, this is all one big stitch up. Everyone knows each other," and just start writing all sorts of nonsense on Google. And it can cause you a lot of issues. So that's
yeah,
where your kind of PR issues or PR risks start to come in.
yeah. And where's the risk for the IP?
In terms of getting the evaluator wrong.
Yeah. Or
Well,
or the report being wrong. I'm just, you know, would that be
the risk for the IP is if the
that
case
disciplinary action? Is it?
Yeah. So there was a while ago, from memory, there's an IP in Leeds whereby they'd had a report done by one of the providers that was heavily pushed by some of the bodies at the time, and the report just referred to the transaction. Oh, sorry, it just referred to the consideration. Didn't actually list out didn't actually define what the consideration was. Just referred to consideration throughout the report. And when the case got reviewed, they basically turned around and said, "Well, this could mean anything. It doesn't actually tell you what consideration they're talking about here. Are they talking about £1? Are they talking about 10 million? What is it?" And the IP from memory had some issues with the regulatory body, but then in the end kind of went back and said, "Well, 1 minute, we've used a provider that you asked us all to use, or, you know, you accredited, and now you're telling us the reports are wrong." And that fell by the wayside for them, luckily for them. But, you know, the risk for the IP is a stakeholder or regulatory body picks something up. And I think increasingly it'll be a stakeholder that does it, or another investor turns around and says, "This isn't valid because this person doesn't meet the criteria, or this report doesn't match what's in the proposals, and therefore it's not valid." And that's the risk for the IP.
Yeah. Okay.
But what I would say is, I think what started off as being something that just needed to be done and be put on a file and never heard of again, I think it's actually it's turned into a bit more than that from what I've seen. Not on every job, but there are cases where they are being looked at more closely.
Yeah. Okay. Thank you very much. Right, I've not had any more questions come through. There are none in the chat box. So unless anyone's got a question that they want to raise now, we're finishing with 4 minutes to spare. So thanks everyone for attending. Like I say, the recording will be sent out either tomorrow or early next week. Again, if anyone's got any topics that they'd like us to cover in future webinars, just drop me an email and we will see what we can do.
If anyone wants to discuss any cases, please do give me a